Every single one of these ETFs has a dividend yield of over 10%. They also pay every single month rather than quarterly. I'm sure that you've heard of options trading and you heard your friend Chad made $10,000 in one day, but then you heard your boy Chad lost $15,000 on another day. So options can be exciting, but they might be exciting for the wrong reasons, especially if you're gonna lose money. Well, I found the safest way to partake in options, and it's coming your way. Now, there's a specific way that you're supposed to invest in these types of ETFs, especially if you're trying to build long-term wealth and passive income forever. So this video is going to teach you all about that and give you the 3 ETFs that I'm really liking right now as far as covered call ETFs. And remember, just knowing what these 3 ETFs are is great, but knowing exactly how to use them to the fullest benefit is going to be the thing that sets you apart and gives you that passive income for life. Now, a covered call ETF is about as confusing as the name would suggest. And so just like I do with everything on this channel, I went ahead and did the research for you and then compiled it into this video so that I could make investing simplified. My name is Nolan Gouveia, my students call me Professor G, and I'm super excited to jump into this one today. So what is a covered call ETF? A covered call ETF is an actively managed exchange traded fund, or ETF, that buys a set of stocks and writes call options on them, engaging in the call writing process as much as possible in order to maximize returns for investors. By investing in a covered call ETF, investors have the opportunity to benefit from covered calls without directly participating in the options market on their own. So basically, in investing, you can do something called options, and I'm not gonna go super deep into that in this video here, but within that, you'd pick a call or a put, somewhat betting that the stock's either gonna go up or go down, and if you're right, you make money. But if you're wrong, you lose money. So in theory, it's mitigating the risk, but also hopefully getting you that upside, specifically in certain times. They're actively managed, which means that they tend to have higher expense ratios than passively managed ETFs that track an index. So these covered call ETFs will definitely be more expensive as far as expense ratio than something that tracks like the S&P 500 or something of that nature. But the extra income could offset that cost. Next, you need to know when not to buy a covered call ETF and when to buy a covered call ETF. You don't want to be buying covered call ETFs when stocks are generally rising and making new record highs on a regular basis. This is a scenario where covered call ETFs would underperform the rest of the market. So the past 10 years, when everything was kind of just going steady and going high, that was not the time to be buying into a covered call ETF. But a good time to be considering buying into some covered call ETFs might be when most of the securities held by the ETF are expected to trade sideways or go down slightly for some time, which is right now. We've dropped a bunch since last year, and lately we've been trading pretty sideways. We'll go down a little bit, we'll go up a little bit, but all in all, nothing too crazy yet. So let's talk about 3 of my favorite covered call ETFs right now, and then I'm gonna tell you which one's my favorite. So the first one on that list is the Global X S&P 500 covered call ETF, XYLD. The investment seeks investment results that, before fees and expenses, generally correspond to the performance of the CBOE S&P 500 Buy Right Index. So XYLD writes covered calls for specifically the S&P 500, which makes it so that you, the investor, don't have to do that. Now, incredibly, XYLD has a dividend of 12%, and it pays a dividend every single month. This means that if you had $10,000 invested in this, you'd be getting an annual dividend of $1,250 or over $100 every single month as a passive income check for doing literally nothing. And XYLD has been doing monthly distributions for 9 years in a row. Now, the expense ratio is higher than most ETFs, like I was talking about before, and this expense ratio is 0.6%. The top 10 holdings are what you can see here, with Apple, Microsoft, and Amazon in the top 3, down over 21% for the year to date, just like VOO or the S&P 500. Over the last 5 years, though, the S&P 500 is up, while XYLD is down 20%. And this is why I was telling you before that periods of a bull market are not great to be holding these covered call ETFs. And so what I just showed you was the past 5 years, and in that time, for the most part, we were in that bull market run. Of course, the regular S&P 500 has done much better than this covered call ETF during that time. And moving on to the next covered call ETF, and a lot of people that I know have really started adding this into their portfolio, especially as of late, and that would be JEPI, the JP Morgan Equity Premium Income ETF. It's an actively managed fund that generates income by selling options on US large cap stocks. The fund invests in S&P 500 stocks that exhibit low volatility and value characteristics and sells options on those stocks to generate additional income. And just like the one before this, it has an incredible dividend yield at 11%. And it pays out every single month. Now, the expense ratio on JEPI is definitely lower than the one before, and it's at 0.35%, which is about half as expensive. The top 10 holdings are seen here, with the top 3 of Bristol Myers Squibb, Exxon, and United Health, which are 2 healthcare companies and an oil company, so very lucrative and very stable. JP Morgan is a household name, and it's definitely not going anywhere anytime soon. But Jamie Dimon is a little bit of a character, and there are some ethical concerns here, so definitely take all that into consideration when you're doing your research. But let's move on to that third one. And this third one is cool because for those of you that really like growth stocks and like the NASDAQ 100 or QQQ, this is going to be something you're going to be interested in. And this one is QYLD. QYLD writes call options on the NASDAQ 100 index, saving investors the time and potential expense of doing so individually. Here's the top 10 holdings in this portfolio, with the top 3 of Apple, Microsoft, and Amazon, like XYLD, and that's because of how big and solid those companies are, so market cap. Now, the thing to really be excited about here is just like how growth stocks usually have the highest appreciation, this covered call ETF has the highest dividend yield of the 3. QYLD has a dividend yield of 16% and it's paid out every single month. QYLD has made monthly distributions for 8 years running, and it has an expense ratio of 0.6, just like XYLD. Now, just like how all the growth stocks are pretty hammered right now in the stock market and how QQQ is down, QYLD is down the most year to date at negative 28%, and over the last 5 years, it's down even more at negative 35%. Remember that this one is basically tracking QQQ or the NASDAQ 100, and over that time, QQQ is actually up in the past 5 years. And so that's very important for you to understand, and that leads us to our next section. So which one of these is my favorite? We need to remember exactly why we're invested in dividends in general, but specifically why would we pick covered call ETF as the strategy for now. So in a second, I'm going to explain how to do this correctly for your portfolio and how to actually make those millions of dollars. Because if you're under 40 and investing in these as your primary strategy, you definitely need to listen up. We're investing in these funds for the dividend, but merely looking at just the highest dividend yield is where a lot of people actually mess this up. So my favorite of the 3 is going to be JEPI, or the JP Morgan fund. While the dividend yield is actually the lowest, it's the most consistent and has the most likelihood of staying consistent no matter what happens in the market, since it invests in solid recession-proof industries like healthcare, oil, and financials. So investing in covered call ETFs is a very interesting strategy, but also one that a lot of people are doing wrong. If we had $500 to invest every month for 10 years, and we decided to pick JEPI, which had an average rate of return every year of about 3.5%, you'd have about $70,388. If you decided to put that money instead into just a regular boring S&P 500 or VOO, which has returned a bit above 10% every year, In 10 years, you'd have $95,624, which is $25,000 more. Now, if you were to invest for 20 years in JEPI, you'd have $169,000. Whereas in 20 years with VOO, or the S&P 500, you'd have over $343,000, which is more than double, and almost $200,000 more than if you were investing in JEPI. In order for our money to work the hardest for us, we first need to put it in funds that are going to compound the most for us and the most consistently long term. The problem with the covered call ETF is that it's only really a smart option during a small period of time, during a recession or during sideways trading. So for me, the only time that I see a covered call ETF strategy being your best bet is if you're very, very close to retirement, or maybe even in retirement, and during a time where it's very apparent that stocks aren't going to really go up or go down. We're kind of in this rebuild phase. But for me personally, and since I have a long time until actual retirement age, there's no reason for me to take my money out of things like the S&P 500 or growth funds or other dividend investing funds that have the potential to grow much, much more than what these are going to do. Once we get to a point where we have a bunch of capital and you just want to put it somewhere so that you get a crazy dividend, that might be another good time for you to be thinking about these, especially since how high these dividends actually are and that they're paid monthly. Then changing from the S&P 500 to something like QYLD gets very exciting, because at that $343,000 point, you'd see a dividend of over $56,000 annually, or almost $5,000 per month in passive income forever without ever having to sell a share. It's just continually pumping out about $5,000 a month that you get a paycheck just for sitting back and being a good investor for those first 20 years. Now, the most important thing about this whole video is that time is your biggest asset and you need to start today. Now you know where to invest in those covered call ETFs for the future, but for right now, you need to know which 3 ETF categories are gonna get you to that huge number and actually build that wealth to a point where you can get that passive income forever. And so to take advantage of the strategy that I just laid out in this video, you need to watch this video now.